Hello everyone, welcome to Finance by Avisha and Arpita. In today's video, we'll understand the balance sheet. Part 1 has already been uploaded on the channel. You can watch first part before watching this video. So coming to the first part of the video, the asset side of the balance sheet. In the previous video, we looked at the liability side of the balance sheet in detail. We will now understand the second half of the balance sheet, that is the asset side of the balance sheet. The asset shows up all the company's assets in different forms right from its inception. Asset in simple term are the resources held by the company which help in generating the revenue. So here is a snapshot of asset side of the balance sheet. As you can see, asset side has two main subsections, that is non-current asset and current asset. Both these sections have several items including with associated notes included within. We look into each one of these line items. Now coming to non-current assets. Non-current assets, or you can say fixed assets. Similar to what we learned in the previous video, non-current assets talk about companies' assets, the economic benefit of which is enjoyed over a long period beyond 365 days. Remember, an asset owned by a company is expected to give the company an economic benefit over its useful life. If you notice, within the non-current asset, there is a subsection called fixed asset with many line items under it. Fixed assets are assets, both tangible and intangible, that the company owns, which cannot be converted to cash easily or which cannot be liquidated easily. Typical example of fixed assets are land, plant, machinery, vehicle, building, etc. Intangible assets are typically considered fixed asset because they benefit company over a period of time. If you can see all the line items within fixed assets, here is a note number 10 which we can explore in greater detail shortly. Here is a snapshot of fixed assets of Amara Raj Battery Limited. The first line item, tangible asset, is valued at rupees 619.8 crores. Tangible assets consist of asset which has a physical form. In other words, these assets can be touched or seen. This usually include plant and machinery, vehicle, building, fixtures, etc. Likewise, the next line item reports the value of intangible assets valued at 3.2 crores. Intangible assets are assets which have a economic value but do not have but do not have a physical nature. These usually include patents, copyright, trademark, design, etc. Remember, when we discuss the P&L statement, we will discuss depreciation. Depreciation is a way of spreading the cost of acquiring an asset over its useful life. The value of asset depletes over time as the asset lose their production capacity due to obsolescence and physical wear and tear. This value is called depreciation expense, shown in the P&L statement and the balance sheet. All the assets should be depreciated over its useful life. Keeping this in perspective, when the company acquires an asset, it is the gross block. Depreciation should be deducted from the gross block, after which we will arrive at the net block. Net block is gross block minus accumulated depreciation. Note the term accumulated is used to indicate all the depreciation value since its incorporation. When you read the basically the tangible asset at 619.8 crores and intangible assets at 3.2 crores. Remember, the company is reporting a net block, which is the net of accumulated depreciation. Have a look at note 10, which is associated with fixed assets. At the top of the note, you can see the gross block, depreciation, amortization, and the net block is highlighted. I have also highlighted two net blocks number which tally with what was mentioned in the balance sheet. Let us look at few more interesting aspect of this note. Notice under tangible asset you can see the list of assets of the company that the company owns. For example, the company has listed building as one of its tangible asset. I have highlighted this in this part. As of 31st March 2013, ARBL reported the building value at rupees 93.4 crores during the year 2014. The company added rupees 85.8 crores worth of building. This amount is classified as additions during the year basically. Further, they also wound up 0.668 crores worth of building. This amount is classified as deductions during the year. Hence, the current year value of the building would be previous year's value of building plus addition during this year minus deduction during the year. So 93.4 plus 85.8 minus 0.668. So that comes out to be 178.5 crore. You can notice this number is highlighted in blue in the above in this image. Do remember, this is the gross block of building. One need to deduct the accumulated depreciation from the gross block to arrive at the net block. In the snapshot, in this one, I have highlighted the depreciation section belonging to the building. As of 31st March 2013, ARBL has depreciated by rupees 17.2 crore, to which they need to add 2.8 crore belonging to the year 2014. Adjusted 0.376 crore as the deduction for the year. Thus, the total depreciation for the year is previous year's depreciation value plus current year depreciation minus deduction for the year. That is 17.2 plus 2.8 minus 0.376. So, total depreciation is 19.736 crore, which is highlighted in red in the image. So we need to build gross block at rupees 178.6 crores and depreciation at rupees 19.73 crores, which gives up a net block of rupees 158.8 crores. That is 178.6 minus 19.73. The same is highlighted in this image. The same exercise is carried out for other tangible and intangible asset to arrive at the total net block number. The next two line items under the fixed assets are capital work in progress and intangible assets under development. CWIP includes building under construction, machinery under assembly, etc. at the time of preparation of the balance sheet. Here it is aptly called the capital work in progress. This amount is usually mentioned in the net block section. CPIW is the work that is not yet completed but where capital expenditure has already been incurred. As we can see, ARBL has rupees 144.3 crores under CWIP. Once the construction process is done and the asset is put to use, the asset is moved to the tangible asset under fixed asset from CWIP. The last line item is intangible asset under development. This is similar to CWIP, but for intangible asset, the work is in progress. The work is in the process, could be patent filing, copyright filing, brand development, etc. This is at a minuscule cost of 0.3 crores from ARBL. All these costs are added to arrive to the total fixed cost of the company. Now coming to the non-current asset other line item. So beside the fixed asset under non-current asset, there are other line items as well. So here there's a snapshot of the same. So non-current investments are investment made by ARBL within a long-term perspective. This stands at rupees 16.07 crores. The investment could be anything: buying listed equity, shares, minority stock in other companies, debentures, mutual funds, etc. So here is the partial, as I could not fit the entire image. So you can see the snapshot of note 11, which would give you a perspective. The next line item is long-term loans and advances, which stands at rupees 56.7 crores. These are loans and advances given out by the company to other group companies, employees, supplies, vendors, etc. The last line item under the non current asset are other non-current asset, which is at rupees 0.122 crores, which include other miscellaneous long-term assets. Now coming to the fourth thing, that is current assets. So current assets are assets that can be easily converted to cash, and the company foresees a situation of consuming these assets within 365 days. So current assets are the assets that a company uses to fund its day-to-day operation and ongoing expenses. The most common current assets are cash and cash equivalent, inventory, receivable, short-term loans, advances, and sundry debtors. So here's a snapshot of the current assets of ARBL. The first line of the current asset is inventory, which stand out at rupees 335.0 crore. Inventory includes all the finished goods manufactured by the company, raw material in stock, goods that are manufactured incompletely, etc. Inventories are good at various stages of production and hence have not been sold. When an product is manufactured in a company, it goes through various raw material processes to work in progress to finished goods. So snapshot of the note 14 associated with the inventory of the company is shown here. As you can see, a bulk of inventory value comes from raw material, work in progress. The next line is trade receivable, also referred to as account receivable. This represents the amount of money that the company is expecting to receive from its distributor, consumer, and other related parties. The trade receivable for ARBL stand out to rupees 452.4 crores. The next line item is the cash and cash equivalents, which is considered the most liquid asset found in a company's balance sheet. Cash comprise of cash on hand or cash on demand. Cash equivalents are short term, highly liquid investment with a maturity date of fewer than 3 months from its acquisition date. This stands at rupees 294.5 crores. Note 16 associated with cash and bank balance is shown here. As you can see, the company has cash parked in various types of accounts. The next item is short-term loans and advances that the company has tendered and is expected to be repaid to the company within 365 days. This includes various items such as advances to supplier, loans to consumer, loans to employees, advance tax payment, income tax, wealth tax, etc. So this stands at rupees 211.9 crores. Following this is the last item of the asset side and the balance sheet item. This is other current asset which are not considered important, hence termed other. This stands at rupees 4.3 crores. To sum, the total asset of the company would be fixed assets plus current assets. That comes out to be 2139.441 crore, which is exactly equal to the liability side. So you can see this here. With this, we have now run through the balance sheet, entire asset side, and in fact the whole balance sheet itself. Let us relook the balance sheet in its entirely. As you can see above, the balance sheet equation holds for ARBL balance sheet. So asset is equal to shareholders fund plus liability. Do you remember from the last few chapters we have only inspected the balance sheet and the P&L statement? However, we have not analyzed the data to infer if the number are good or bad. We will do that when we look at the financial ratio video. The next video we look into the last financial statement, which is the cash flow statement. However, before we conclude this video, we must look into many ways the balance sheet and the P&L statement are interconnected. So connecting the P&L and the balance sheet. Let us now focus on the balance sheet and the P&L statement and the multiple ways these are connected to each other. Have a look at this image. In the image, we have the line items on the typical standard P&L statement on the left hand side corresponding to that of the right hand side. We have some of the standard balance sheet items from the previous chapter. You already know what each of these line item mean. However, we will now understand how the P&L and the balance sheet items are connected. To begin with, consider the revenue from sales. When a company makes a sale, it incurs expense. For example, if the company undertakes an advertisement campaign to spread awareness about its product, the company has to spread cash on the campaign. The money spent towards the money spent tends to decrease the cash balance. If the company makes a sale on credit, the account receivable go higher. Now coming to operating expense. Operating expense include the purchase of raw material, finished goods and other similar expenses. When a company incur these expenses to manufacture goods, two things happen. If the purchase is on credit, which invariably is, then the trade payable, account payable go high. Second, the inventory level also get affected. Whether the inventory value is high or low depends on how much time the company needs to sell its products. When the company purchases tangible asset or invest in brand building exercise, intangible assets, the company spreads the asset purchase value over the asset economic useful life. This tends to increase the depreciation mentioned in the balance sheet. Do remember the balance sheet is prepared on a flow basis. Hence, the depreciation in the balance sheet is accumulated year on year. Please note, depreciation is the balance sheet is referred to as the accumulated depreciation. Other income includes received in interest income, sales of subsidiary companies, rental income, etc. Hence, when company undertake investment activity, other income tend to get affected. When the company undertake debt, it would be short term or long term. The company obviously spends money towards financing the debt. The money that goes towards financing the debt is called the finance cost by or the borrowing cost. Hence, the debt increases, the finance cost also increases, and vice versa. Finally, as you may recall, the profit after tax part adds to the company's surplus, which is a part of shareholders' equity. Now, let's talk about the key takeaways from this chapter. The asset side of the balance sheet displays all the assets of the company. O's assets are expected to give an economic benefit during its useful life. Assets are classified as non-current and current assets. The useful life of non-current asset is expected to last beyond 365 days or 12 months. Current assets are expected to pay off within 365 days or 12 months. Assets inclusive of depreciation are called gross block. Net block is gross block minus accumulated depreciation. The sum of all the assets should equal to sum of all the liabilities. Only then the balance sheet is said to have balanced. The balance sheet and the P&L statement are inseparable. They are connected in many ways. So this is all about the balance sheet statement. If you like the video, hit like and share it with your friends so that they also gain knowledge. Thanks for watching. Bye bye. And do subscribe to the channel. Bye.